Over the last 2-3 decades, there has been a drastic shift in the investment pattern in India. In the 90s and 2000, people used to invest their money in LIC policies, FDs, physical gold and real estate. A very small percent of people would invest in stock market. Mutual funds were a very new concept in the 2000s. But in the last few years, there has been a huge shift in investment pattern where the young generation is now focusing on stocks and mutual fund for wealth creation. There have been multiple factors for this shift in investment pattern. One of the major reasons is increasing awareness among investors regarding stock market and mutual fund. Today, investors understand that India is a growing economy and it makes sense to invest in the Indian economy for wealth creation. Moreover, the interest rates on FD have fallen drastically. So FDs are not looking lucrative anymore. Then people now also understand that it is not a wise decision to mix insurance and investment. Now within stocks and mutual fund, if you are a salaried person or a business owner who does not have enough time for research, it makes sense to keep major exposure in mutual funds. And within mutual funds, until a couple of years ago, people used to invest in active funds. But now, investors have realized the importance of index funds because it is getting really difficult for active funds to beat the index. Hello friends, my name is Sahil and this is my Personal Finance Academy where I explain everything about money management in layman's language. In this video, I want to focus on one of the emerging category in mutual fund, that is index funds. In fact, many people claim that index fund or passive investment is the future of mutual funds. Now, what is an index fund? So, an index fund is basically a fund that simply replicates an index. For example, if an index fund replicates Nifty 50, then it would have all 50 stocks in the portfolio that are part of Nifty 50. And it would be in the same exact allocation. So, if Infosys has 5% weightage in Nifty 50 by free float market cap, then out of rupees 100, rupees 5 would be invested in Infosys and so on. So basically, an index fund is simply a copy of an index. By the way, there are a lot of indices in India. For example, you have Sensex, Nifty 50, Nifty Next 50, Nifty Midcap 150, Nifty Smallcap 250, etc. So there are multiple index funds within each category. In this video, I will try to help you understand why index funds are the future of mutual fund, and then I will share my list of top 5 index funds. The reason why people say that index funds are the future of mutual fund is because it has been proven in developed countries like US that in the long run, active funds are not able to beat the benchmark. So active funds are basically the funds where the fund manager selects the stock from his or her choice and keep buying and selling stocks actively. The ultimate goal of each active fund is to beat the benchmark. But if you look at the last few years, more than half of the index fund in the large cap category in India are not able to beat the benchmark. One of the major reasons is high expense ratio. Active fund charges an expense ratio in the range of 0.5% to 1.5% for direct plan, whereas majority of index funds have very low expense ratio. Some of them have expense ratio below 0.5%. So there is almost a gap of 1% in the expense ratio of active funds and index funds. This 1% gap might look very small, but in the long term, this 1% can create a huge difference as it is charged every year. In the future, as Indian economy becomes more efficient, it would be even more difficult for active funds to beat the index, and hence index fund would be a better option due to their lower expense ratio. Before I share my list of top 5 index funds, I want to clarify that there are many good index funds available in the market and my list of index fund is not the only top index funds. Moreover, this is only for educational purpose and you need to do your own research before investing your money. So I have shortlisted the index fund mainly on 3 parameters. First is expense ratio. So expense ratio is the fee for managing the fund. Lower the expense ratio, better it is. Next criteria is tracking error. Tracking error is the difference between the index return and actual return from the index fund replicating the index. Again, lower the tracking error, better it is. And third criteria is AUM size. High AUM size suggests confidence of investor in the fund. Although since index funds are relatively newer in India, the AUM size is not that high. Also, there are new funds being launched in the market and hence they have low AUM. But I haven't considered relatively new funds with lower AUM in my list of top 5 funds. Number 5 fund in my list is from Nifty 50 Index Fund. Between Sensex and Nifty 50, I prefer Nifty based index fund as they are more diversified with top 50 stock rather than top 30 stock. There are many index funds in Nifty 50 category, but I prefer UTI Nifty Index Fund. It basically replicates the top 50 stocks in Nifty 50 category. It is one of the oldest index fund in India and it was launched in January 2013. Its fund size is Rs 4,210 crore, which is the highest in Nifty 50 index fund category. In terms of return, UTI Nifty Index Fund has given a CAGR return of 14.07% in the last 5 years. Its expense ratio is 0.2% and tracking error is also one of the lowest with 0.02% tracking error in last 1 year. In terms of sector allocation, 37.2% allocation is in the financial sector, 17.13% in technology sector and 12.1% is in energy sector. The top 3 holding include your Reliance, HDFC Bank and Infosys. Now this would be more or less the same in all major Nifty 50 based index fund as essentially everyone is trying to replicate the same Nifty 50 index. The major differentiator here is expense ratio and tracking error. So lower the expense ratio and tracking error, better it is. And UTI Nifty Index Fund has one of the lowest expense ratio and tracking error so far in the Nifty 50 Index Fund category. Number 4 fund in my list is HDFC Index Fund Nifty 50. It is also one of the oldest index fund and was launched in January 2013. Its fund size is Rs 3,343 crore, which is the second highest in Nifty 50 Index Fund category. In terms of returns, HDFC Index Fund Nifty 50 Fund has given a CAGR return of 13.99% in the last 5 years. Its expense ratio is also 0.2% and tracking error is also one of the lowest with 0.03% tracking error in last 1 year. In terms of allocation, again financial, technology and energy are the top 3 sectors and Reliance, HDFC and Infosys are top 3 holding. Number 3 fund in my list is from Nifty Next 50 category. Now the reason why I prefer this category is first, it represents stocks ranking from 51 to 100 in terms of free float market cap. So these are the stocks that are not as large as Nifty 50 but have the potential to grow and move into Nifty 50 category. Second important reason is diversification. Nifty 50 index has 37% weightage of financial stocks. So Nifty 50 index is more skewed towards financial sector. However, Nifty Next 50 index is nicely balanced in terms of sector allocation with consumer goods sector having highest allocation with 18.8% weightage. The second highest allocation is of financial sector with 17.3% allocation. This is followed with pharma and then consumer services sector. Within Nifty Next 50 category, my number 3 pick would be again from UTI Fund House. It is UTI Nifty Next 50 Index Fund. It is one of the best performing fund in Nifty Next 50 category with a fund size of around 1,097 crore and 3-year average CAGR return of 10.86%. Although the return of Nifty Next 50 index is lower as compared to Nifty 50, but I believe that Nifty Next 50 category will perform much better in the long term. So it is good to have exposure in Nifty Next 50 index. UTI Nifty Next 50 index has an expense ratio of 0.32% and tracking error of 0.19% in last 1 year. Its top 3 sector include financials, consumer goods and healthcare. And top 3 stocks include Adani Enterprise, InfoEdge and Apollo Hospitals. Number 2 fund in my list is Axis Nifty 100 Index Fund. Now it is a combination of Nifty 50 and Nifty Next 50 Fund. So you can either invest in Nifty 50 Index Fund or Nifty Next 50 Index Fund individually, or you can invest in Nifty 100 Index Fund together. Only difference is that when you invest individually, you can decide how much percent you want to invest in Nifty 50 and Nifty Next 50. For example, you can invest 50% in Nifty 50 and 50% in Nifty Next 50 category. However, when you invest in Nifty 100 index fund, around 85% of the money is invested in Nifty 50 companies and the remaining only 15% is invested in Nifty Next 50 companies. This is because Nifty 50 has a very high market cap and hence they have a weightage of 85% in Nifty 100 fund and only 15% weightage is for Nifty Next 50. Axis Nifty 100 index fund has a fund size of Rs 477 crore. Expense ratio is 0.16% and tracking error is of 0.27% in the last 1 year. The top 3 sectors in Axis Nifty 100 include financials, technology and energy, and top 3 companies include Reliance, HDFC Bank and Infosys. Number 1 fund in my list is not from Indian market. It is an index fund that replicates the US stock market. Personally, I like to have some exposure in US stock as it provides diversification and help me to invest in some of the top-notch companies of the world. Now there are mainly 2 categories of US based index fund, Nasdaq 100 and S&P 500. Nasdaq 100 represent top 100 listed companies in the US and S&P 500 represent the top 500 companies. I personally prefer top 500 companies. Although recently Nasdaq 100 has outperformed S&P 500, but it was mainly due to outperformance of selected technology stocks where Nasdaq 100 has higher allocation. But in the long term, I prefer the S&P 500 index that include the top 500 companies in the US. And my number 1 pick in the category is your Motilal Oswal S&P 500. This fund has an AUM of 1,621 crore and has given a return of 34% in last 1 year. We don't have 5-year data as it is a relatively newer fund. Its expense ratio is 0.4% and tracking error is 5% in last 1 year. Well, the tracking error is too high, but unfortunately, we don't have many options in this category in India. In fact, it is the only index fund in India as of today that allows investment in S&P 500 funds of the US. So this is my list of top 5 index funds in India. I have tried to balance the funds across categories. If I summarize, the list include UTI Nifty Index Fund, HDFC Index Fund Nifty 50, UTI Nifty Next 50 Index Fund, Axis Nifty 100 Index Fund and Motilal Oswal S&P 500 Index Fund. Have you invested in index fund? If yes, let me know in the comments. By the way, you can invest in these passive funds using Finity app. There are 5,000 plus mutual funds with 42 plus AMCs under one roof of Finity. It has some unique features that I did not find in other apps. Let's quickly explore their app. On the main page, you can check out their offering of passive index fund. There are 4 categories. You have got Nifty backers that basically mirrors the Nifty index. Then you have Sensex backers that mirrors Sensex. Then you have thematic fund that mirrors a particular theme, which could be, for example, pharma theme. Then you have global indices that basically mirrors global funds, for example, Nasdaq 100, S&P 500, etc. For example, when you click on Nifty backers, you can see the details about Nifty index. Then you can filter the funds based on 1 year, 3 year, 5 year performance. Then you can sort the funds by expense ratio, tracking error, returns, ratings and fund size. Now when you click on specific index, let's say UTI Nifty index, you can see the fund return chart of 1 month, 3 months, 6 months, etc. Then you can see the expense ratio, tracking error and fund size. If you want to learn more, you can explore expense ratio and tracking error. Then there are various tabs like returns where you can see the periodic return of the fund. Then you can explore fund information like its launch date, etc. Then you can look at the portfolio details like sector allocation, top holding in the fund. Then you can also look at the risk related details. So if you wish to invest, then you have the option of SIP versus lump sum investment. Again, it is free of cost, as Finity does not charge any commission. Hence, savings are directly passed on to the investor. So I hope you will find this video useful. I will see you with another video. Till then, take care.